Principles for purchasing a home. My number one principle, and I'm not just making this stuff up, this is wisdom from many, many different advisors. People that have huge long track records of laying out financial principles for people to live by. So listening to folks like Thomas Stanley, who sadly passed away a year or two ago, Dave Ramsey, many others. First off, do not purchase a home unless you are certain that you're going to remain in place there for at least 5 years. And 10 years is better. And here's why. The cost of getting in and out of a home is quite expensive. If you're using realtors, you're going to have some significant real estate commission fees you're going to pay. If you are, depending what jurisdiction you live in British Columbia, you're going to pay a property transfer tax, which is a big whack upside the head. So what you want to do is not get caught in this downdraft where we buy a home and say 2 years later decide, well, I'm going to switch. And then what we find out is, maybe the market's softened a bit. Maybe the market's gone down. And of course, right now as we're talking about this in May of 2017, that doesn't seem likely. Our bigger problems tend to be in some major markets like Vancouver and Toronto, and even where I usually am in Kelowna, where prices are going up and the market is very frothy and things are starting to get very unaffordable. But believe it or not, markets still go down, and it will. It absolutely will at some point. So just to give you a bit of an anecdote, back in 2006, 2007, if you bought a home, well, let me give you the worst examples that tended to go on. People were buying new condos like there was no tomorrow back in 2006, 2007, even in Kelowna. They were lining up so that they could put down their deposit money, $10,000, $20,000, and then they would, the condo hadn't even begun to be built yet, so it's going to be a couple of years till they had to pay the rest of the money. And what everybody thought they were going to be able to do was flip that condo before they even had to close, before they took possession, so that they would make a nice profit flipping this condo that they never actually took possession of. Well, that sounded great, but what happened was people put their down payment down, and 18 months later, when their condo was finally ready, they had to close. Now, by then, it's late 2008, and the global economy had collapsed. Along with it, the real estate markets. And credit was getting very difficult to get at that point as well. So it was very challenging for people to even go and get a mortgage to buy the place that they were trying to commit to. And so what happened was people thought all they were putting at risk was their $10,000 or $20,000. If they never closed, they would just lose that. But that was not what happened. The market fell by 20 to 30%, depending where you were. And people were having to now pay, for example, the price they'd agreed to, $300,000 for a condo that was now only worth $225,000. And they couldn't get out of it. They had a contractual obligation to close on that. And so at that point, because many of them didn't have any serious down payment money, maybe the $10,000 was all they were putting down, they now had a $270,000, $280,000 mortgage on a condo that they could only then have sold for $225,000. It's only just now, it's now 2017. It's 2017, and just now, those condos from that time are in a position where people can sell them and pay off the mortgage. They don't make any profit. They've been making mortgage interest payments for 9 years. And now, just now, they're finally able to get out from under it. That's why you don't want to buy something unless you're going to be in it for at least 5 years, preferably 10. All right. Let's go to the next. Okay, second principle, have a cash down payment of at least 20%, ideally. And that's because if you're putting in less than 20%, you're going to be paying for what's called mortgage default insurance, or what sometimes is called CMHC fees. It's insurance for the bank, so that if you are unable to fulfill your obligation, the bank has to foreclose, the bank recovers its money. And there's a fee that goes with that. Depending how small your down payment is, that fee can be thousands of dollars. So you want to have at least 20%, or pardon me, you ideally will have at least 20% to put down. However, if you can't do that, please be sure that you're putting down at least a minimum of 10%, because anything less than that, and even just the realtor fees and the getting in and out fees and expenses that will happen, will cause you to be underwater. By underwater, what we mean is you owe more on the mortgage than the value of the property is that you can actually realize from a sale. And it gets very challenging, because if you are underwater on your mortgage, let's say you had one of those condos that you had paid $300,000 for, you put $20,000 down, so you had a $280,000 mortgage, it's only worth $225,000. If you want to sell and transfer the title of that property, you are going to have to bring $55,000 cash, the difference between $225,000 and $280,000, in order to close. That's just to get out of it. So you would have not have the property, lost whatever down payment you put in, and you'd have to have paid another $55,000. So these kinds of things can be very damaging to your finances. That's why you want to make sure that you're following these principles. All right, next, keep your mortgage flexible and run it on a 15-year amortization. So what I mean by keeping your mortgage flexible is that you are going to have options to make payments in all sorts of different ways, in addition to your regular monthly payments. So for example, a lot of mortgages will allow you to make an extra monthly payment at the beginning of every month, or they'll allow you to pay down a certain percentage, maybe 10% once a year, or there's different types of formulas they have, but in any event, they allow you to prepay your mortgage at a faster rate than you are required to do. The advantage to that is if you get in a position where you get some cash happening, you can rapidly pay down your mortgage and get rid of a lot of your interest cost. Now, the reason we pick a 15-year amortization is because we don't want this thing to go on forever. The game that a lot of people play, and it's a very bad game, is that they go out, they get a 30-year amortization mortgage. They own the house for 6 years. By the way, that is about in Canada, it's actually about 7 years that people tend to own a home on average. So they own the house for 6 years, and then they sell it, and they buy up. They buy something bigger and fancier. And then what happens is, rather than setting their new mortgage on their new place at 23 years, the 30 years they started with, less the 7 years they've been paying, they reset it and they go back to 30 years. So they're on the never, never plan. They are never going to get this thing paid off. So you want to be in a 15-year amortization, and that's going to really limit how much interest you're going to pay over the life of your mortgage. It has a huge impact on your finances. All right, more principles. Keep your home costs to 30% of your income. And that's so you don't join the ranks of what are called the house poor. That is, you're paying so much of your income out to just have your house that you can never do anything else. You can never go on vacation. You can't afford even to properly maintain it. You can't afford to operate a vehicle. You can't do things with your kids. You're just suffocating under the pressure of paying 40 or 50 or even 60% of your income to own a home. And when I'm saying your home costs, that includes paying your utilities, your property taxes, strata fees, or maintenance costs. If you go in and buy yourself a 35-year-old home that's never had the roof replaced and never had any of the major appliances replaced, well, in due time, in short order, you're going to be paying to replace the hot water tank, to replace the furnace, to replace the roof, etc., etc., etc. And so you got to have some money that you can use to do that. Otherwise, you are doing what's called eating your capital. That is, the value of your property is depreciating. The equity in your property is depreciating because it's just not being maintained. Buildings deteriorate. They just do. The value that goes up in home ownership is not the building. The building is going down in value. It's the land that's going up in value. Buildings never go up in value, only down, because they are hard assets and they require maintenance and they deteriorate like anything. All right. One more principle: keep your mortgage to 2 times your annual income. So if you're in a family that has a combined family income of $100,000 a year, then make your mortgage ideally no more than $200,000. So, simple principle. These principles will keep you from just the many, many problems that a lot of people get into in home ownership. It's going to keep you comfortable. It's going to keep the rest of your finances comfortable. And it's going to keep you completely out of the ditch in home ownership, no matter what happens. And here, if you think that things can never go completely badly because we've got such low interest rates and the market is going so crazy, in 1981, the mortgage interest rate topped out at about 21 or 22%. So imagine that you've got a $500,000 home. That's about the average price of a home in Kelowna. And you've got a $400,000 mortgage, and interest rates have gone to 20%. 20%. That means the interest costs on your mortgage in 1 year are now going to be $80,000 a year. That's the kind of thing that was happening in 1981. Now, I can tell you something. It was a fantastic time to buy a house if you had cash, because the price of houses was plummeting, because so many people were being forced to sell because they could not afford the renewal of their mortgage. Which brings me to one last point that's not in my slides here. Always go with the 4 or 5 year fixed rate mortgage rate. Yes, you can do better usually with a floating rate. Yes, historically, floating rates have been lower than fixed rates. But we're not trying to gamble on what's happening with rates. We're trying to manage our personal finances and to sleep at night. And that's the way that we do that. We fix as many of our costs as we can, and then we sleep well at night because we know that we can manage and afford come what may. All right. So that's our principles for house purchases. I'm going to throw a couple of asides here on that. One is they're principles. Your circumstances may vary. Your mileage may vary, as I would put it. And that means that, let's say, for example, you live in Toronto or Vancouver right now, or even some of the secondary markets that are really being hammered by higher prices. In British Columbia, that would be Victoria and Kelowna. And probably even other places like Nanaimo and such. You have to make choices that make sense for you. So probably you're not going to be able to get yourself in a position where you can make such a large down payment if you're buying your first home that your mortgage is perhaps only 2 times your annual income. You may have to ratchet that up a bit. But if you're going to do that, you need to make room somewhere else in your finances so that you've got breathing room. Because all too often, people get suffocated by the cost of owning their home, and it's just oppressive and it's miserable. And it can also put you in a position where you're forced to sell. And then it's just completely awful because you're usually not getting the kind of price you should be getting for your house. But you may have to make some adjustments and choices around the way circumstances are. Another really powerful tool is to add a mortgage helper to your house. So whether it's a carriage home or a basement suite or what have you, if you can use that as a way to help you manage having some additional mortgage. But one of the biggest traps that many people fall into, especially first-time or early homeowners, is they think that they need to buy the house that they last lived in with their parents. Well, our parents didn't start out there. Our parents started in small houses. The typical house, in fact, in the 1960s, was probably a 2 or 3 bedroom, single bathroom home. Not something with 5 bedrooms and 4.5 bathrooms and a family room and a media room and. So buying more house doesn't make your life happier and bigger and better. It really doesn't. But having too much house can make your life miserable and painful.